Hello. In the world of business and finance, financial statements are essential tools for understanding a company's condition. However, comparing financial statements across different companies or periods can be challenging, especially when the company sizes vary. To solve this, one widely used analytical method is common size analysis. In this video, we will explore what common size analysis is, how it works, and the benefits it offers. Stay tuned until the end to learn how this technique can help in financial decision-making. Common size analysis is a financial analysis method that expresses each component of financial statements as a percentage of a specific total, making it easier to compare across periods or between companies of different sizes. In an income statement, each item, such as production costs, operating expenses, and profit, is calculated as a percentage of total revenue. Meanwhile, in a balance sheet, each component, such as assets, liabilities, and equity, is expressed as a percentage of total assets. For example, if a company has total revenue of $1 million and its operating expenses amount to $400,000, common size analysis will show that operating expenses represent 40% of revenue. This method helps us understand how different elements of financial statements contribute to a company's overall financial condition. Common size analysis serves several key functions that benefit company management, investors, and financial analysts. The first function is analyzing financial trends. By converting financial statements into percentages, we can observe changes over time. For example, if operating expenses increase from 40% to 50% over several years, it could indicate inefficiencies in cost management. The second function is comparing performance with other companies. In the business world, companies vary in size. If we compare two companies with different revenues, absolute numbers may not be very informative. However, if one company has a net profit margin of 15% while another has only 8%, we can conclude that the first company is more efficient in generating profits. The third function is simplifying financial statement interpretation. For investors or business owners, financial reports are often filled with complex numbers. By converting them into percentages, we can more easily understand how different financial elements relate to one another and identify areas for improvement. There are several benefits to using common size analysis in evaluating financial statements. The first benefit is identifying a company's strengths and weaknesses. If operating expenses or debt levels are too high compared to the industry average, the company can take steps to address these issues, such as reducing costs or improving operational efficiency. The second benefit is assisting in strategic decision-making. By gaining a clearer understanding of a company's financial structure, management can develop more effective strategies to enhance profitability and cost efficiency. The third benefit is helping investors assess company performance. Investors do not just look at profit figures but also examine how a company manages costs, assets, and liabilities. If two companies have the same net income but one has significantly higher debt levels, investors may prefer the company with a healthier financial structure. Additionally, common size analysis is valuable for long-term financial planning. By tracking financial trends over time, management can better prepare for future challenges and opportunities. The conclusion: common size analysis is a highly useful technique for understanding financial statements. By presenting figures as percentages, this analysis enables more accurate comparisons across different periods or between companies of different sizes. Its functions include trend analysis, industry comparisons, and simplifying financial statement interpretation, while its benefits include improved strategic decision-making, operational efficiency identification, and better investor insights. By applying common size analysis, companies can gain a clearer understanding of their financial structure, enhance efficiency, and develop more effective business strategies. We hope this information is useful to you. Don't forget to like, share, and subscribe so you don't miss out on more finance and business insights. See you in the next video.